Welcome back to Investing Talk Podcast. Today, we're zooming in on SoFi Technologies. You shared some really interesting information about this company, and our goal is to really distill the most important insights for you right now.
Absolutely.
We've got a mix of recent stock analysis, a look at how the company's performing financially, and the latest opinions from big investors and market analysts. Let's get right to it and try to make sense of what's happening.
Sounds good. And to really get a handle on SoFi's current situation, I think it makes sense to start with how the stock's been trading.
Okay.
Recently, it was at $10.64, which is actually a pretty significant drop, more than 12%, like in just one day.
Wow, yeah.
And, over the past year, the price has swung quite a bit. We're talking a low of $6 or a month cents up to a high of $18.42. That kind of movement definitely suggests some strong forces at play.
Okay, so there's been some serious volatility, yeah. And what's interesting is that the amount of trading in the stock, the volume, has actually been lower recently. What could that tell us?
Well, that dip in trading volume might indicate that, while there's been selling, perhaps the urgency or the conviction behind it is decreasing. It could also simply mean fewer people are actively buying or selling right at these price levels. A bit of wait and see, maybe.
Now, when we look at some of the technical indicators, things get a bit more complex, right?
Yeah.
The average price over the last 50 days is around $14.20. And over the last 200 days, it's about $13.31. The fact that the current price is below both of those generally points to a downward trend in the stock, doesn't it?
That's the common way to interpret it, yeah. Think of these moving averages as like lines that smooth out the daily price changes to give us a clearer picture of the overall direction. So when the current price is consistently below those averages, it often signals that both the short-term and longer-term trends are leaning negative.
There's also some talk about a potential retest of a cup and handle pattern around $10.30 to $10.66. That sounds like some Wall Street lingo.
Yeah.
Can you break that down for us a bit?
Sure, yeah. The cup and handle, it's a chart pattern that some investors believe suggests a stock might be about to move higher.
Okay.
So the retest would involve the price dropping back to a level where it previously broke out. If it holds at this level, it could confirm that the upward momentum is still there.
Ah, I see.
However, the analysis suggests that if the price falls below that, say $10.30 to $10.66, well, we could see it slide further, maybe even down to the $9.07 level from an earlier gap back in October.
Okay, so in the short term, things look a little shaky based on that. But the analysis also mentions that this recent price drop might mean the stock is oversold. What does that imply for a potential rebound?
Right. So when a stock is considered oversold, it basically means the recent selling might have been, let's say, too intense, and the price has dropped perhaps more than it fundamentally should. This often suggests the possibility of a bounce back upwards as buyers see an opportunity. Think of it like a stretched rubber band. It can only be pulled so far before it kind of snaps back.
Okay, so putting the technical picture together then, the current suggestion seems to be to hold, but maybe consider buying if the price drops down to around $8.50. That sounds like a cautious stance, given all these different signals.
It really reflects the uncertainty we're seeing in the technical data, doesn't it? You've got the downward trend suggested by the moving averages, but that's countered by the possibility of an oversold bounce and also the potential failure of that bullish cup and handle pattern. So waiting for more clarity around those key price support levels.
Well, it's a prudent approach to managing risk, Okay, that makes sense. Yeah. Let's pivot now and take a look at SoFi Technologies as a company. They describe themselves as an online personal finance company and a digital bank. They offer a really wide array of services, everything from loans and credit cards to investing and banking, all accessible through their apps and website.
Right.
Their stated goal is to empower people to achieve financial independence.
And what stands out immediately, I think, is the breadth of their offerings. Unlike some newer financial technology firms, fintechs that might specialize in just one or two areas, SoFi is really aiming to be a comprehensive platform for a wide range of personal financial needs.
Like a one-stop shop.
Kind of, yeah. And that strategy, it has both advantages, in terms of potential customer reach, but also challenges. Managing all those diverse business lines in a competitive landscape isn't easy.
We saw some positive movement in the stock price back in February of 2025, around 6.4% or so. That seemed to be driven by some positive quarterly earnings results and news of strategic expansions. Can you give some more details on that period?
Yes, exactly. Their report for the fourth quarter of 2024 showed total revenue of $734.1 million,
Wow.
which actually beat what analysts were expecting. So that indicates their core businesses are indeed growing, and some of their strategic initiatives seem to be gaining traction.
However, the financial picture wasn't entirely rosy, was it? I saw the EBIT margin, that's a measure of operating profitability, was negative at negative 8.2%. That definitely raises some eyebrows about their ability to actually make money right now.
It does, yeah. While strong revenue growth is certainly a positive sign, that negative EBIT margin really highlights that the company is still spending more on its operations than it's earning from them.
Right.
And this is a key metric investors will be watching very closely in future reports to see if that trend improves. Now, for many growth-focused tech companies, especially in their earlier stages, a negative EBIT margin isn't totally unusual.
Okay.
As they invest heavily in expansion, acquiring new customers, the critical thing to monitor is whether this margin shows a trend of improvement over time.
We also have some figures on their leverage, a ratio of 5.6, and their total debt compared to their equity, which is 0.54. How should we understand these numbers in terms of their financial health?
Well, these figures suggest that SoFi isn't taking on an excessive amount of debt relative to its assets and its shareholder equity. A leverage ratio of 5.6 indicates that for every dollar of equity, they have about $5.60 in assets, which isn't alarmingly high, especially for a financial institution. Similarly, a debt-to-equity ratio of 0.54 means they have less debt than equity, which generally points to a reasonably stable financial foundation. But it's important to reiterate, like we said, a healthy balance sheet doesn't automatically translate to profitability. That's still the key question.
So when we look at potential warning signs, that negative profit margin and the volatility in the stock price are definitely things to keep an eye on. But on the positive side, you have the strong revenue growth and these strategic partnerships, like that $525 million deal with PGIM. What was that all about?
Right, that $525 million securitization deal with PGIM is pretty significant. Securitization, in simple terms, is like SoFi taking a bunch of similar loans they've issued,
Okay.
packaging them together, and then selling them as bonds to investors like PGIM. This achieves a couple of things. It provides SoFi with a large infusion of cash up front, and it also transfers some of the risk associated with those loans to the investors. It's a common practice in the lending industry, and it signals that big institutional investors have some confidence in the quality of SoFi's loan portfolio.
Interesting.
And also, those benefits offered through SoFi Plus, their membership program, they seem to be a successful way to keep customers engaged and using more of their services.
Okay. Shifting our focus a bit to how the market feels about SoFi. It seems recent news and some analysts have a generally positive view. They particularly note SoFi's strong position in digital banking, especially among younger customers, and the benefits of that SoFi Plus program you mentioned.
Yeah, this positive outlook often reflects the, inherent growth potential and innovative nature of companies in the fintech space. Analysts might be willing to look past the current profitability hurdles, focusing instead on the significant long-term opportunities within the digital banking sector, especially as younger digitally native generations become a larger segment of the financial services market. And SoFi's comprehensive service offering positions them well to capture a significant share of this market, potentially.
When we look at who else is in this space, companies like Chime, Robinhood, Lending Club, what gives SoFi an edge over these competitors, do you think?
Well, SoFi's primary advantage seems to be the breadth of its services, like we touched on.
The one-stop shop idea again.
Exactly. While some competitors might concentrate on just one or two specific areas, like stock trading or maybe just certain types of loans, SoFi provides a much wider array. This could potentially allow them to serve more of a customer's total financial needs within a single platform. And that diversification could be a key strength in the long run, fostering deeper customer relationships and greater overall revenue per user.
Looking to the future then, what are some key things investors should be watching for with SoFi? Obviously, future earnings reports will be crucial, right? As will any updates on the expansion of SoFi Plus. What are some potential challenges or risks on the horizon?
Well, one significant risk for pretty much any financial technology company is regulatory changes.
Always a factor.
Oh, yeah. The financial services industry is heavily governed, and new rules or interpretations could impact SoFi's various business lines. And then, of course, broader economic conditions and overall market volatility can significantly affect the stock price, especially for these growth-oriented companies that may not yet have a long track record of consistent profitability.
We also saw that some big institutional investors firms like Trexquan Investment, Creekmur Asset Management, and others actually increased their holdings in SoFi during the fourth quarter. What can we learn from that kind of activity?
Well, when institutional investors, these big players, increase their stakes in a company, it can often be interpreted as a vote of confidence in its future prospects. These are typically sophisticated investors with significant resources dedicated to research and analysis. However, it's important to remember that institutional buying doesn't guarantee future success.
True.
And their specific reasons for investing can vary widely. It's just one piece of the puzzle, really.
So FI's earnings per share for the fourth quarter came in at $0.05, which was actually better than expected. But it seems their outlook for the future, their forward guidance, was a bit cautious. And that seemed to dampen some of the enthusiasm. Why that kind of reaction?
Yeah, beating earnings expectations is generally a positive signal, no doubt. But forward guidance gives investors the company's own view of what they expect to achieve in the coming periods.
Their forecast.
Exactly. And if that forecast is more conservative than what investors were hoping for, it can create concerns about the pace of future growth or maybe the timeline for achieving profitability. And that can lead to a more muted or even negative market reaction, even despite the positive past results.
Okay. Finally, let's touch on what the analysts are saying. We're seeing a real mix of opinions here. Citigroup has a buy rating, target $18, but then UBS and Goldman Sachs are neutral with lower targets, and Morgan Stanley has an underweight rating, target $13.
Right.
The average one-year price target from Wall Street is around $13.73, but the recommendations are clearly divided. That really highlights the uncertainty surrounding the stock, doesn't it?
It absolutely does. This divergence in analyst ratings and price targets really reflects the ongoing debate about how to value SoFi and its future path towards consistent profitability.
Yeah.
Some analysts clearly see the long-term potential of its expanding platform and are optimistic, while others are more cautious given the current financial metrics and those broader economic uncertainties we talked about.
And the stock performance itself reflects that mix, right?
Yeah.
Big gain over the last year, but down quite a bit year to date.
Precisely. That performance underscores the volatility and the different perspectives on its immediate future.
So, to bring it all together for you, the listener, the technical analysis suggests maybe a cautious approach in the near term. The fundamental picture shows strong growth on the revenue side, but, there are still questions around profitability. Market sentiment seems cautiously optimistic, maybe. But the experts on Wall Street are definitely not all on the same page.
Mm-hmm.
Our overall take, considering both the technical and fundamental information you shared, is probably leaning towards hold for now. The revenue growth and strategic moves are encouraging, definitely. But those profitability challenges and the market volatility require close attention.
Absolutely. Upcoming earnings reports and any news on the regulatory front will be critical indicators to watch.
So, as you can see, we've taken a pretty detailed look at SoFi today, examining everything from its recent stock trading patterns to what the analysts are predicting. What's really interesting, I think, is this contrast we keep seeing between strong revenue growth and the ongoing challenges in achieving consistent profitability.
It's the core tension, isn't it?
Yeah. And this brings up a really important point for you, the listener, to consider. How do you personally weigh the potential for significant future growth against the current financial realities of a company like this? It's not always an easy balance.
Definitely something to think about.
We really hope this discussion has provided you with a clearer perspective on the information you shared with us about SoFi. There's always more to explore, of course, and we encourage you to continue digging deeper into these points.
For sure.
And hey, if you found this insightful, please do subscribe, like, and maybe leave a comment. We always appreciate hearing your feedback. Thanks for tuning in.